When someone asks, how does my credit score affect my interest rate? What they're really wondering is my credit going to cost me money? Because getting approved, well, that's one thing, but getting approved at a rate that's going to cost you tens of thousands more over time, well, that's something else entirely. So let's remove the mystery. Your credit score doesn't just determine whether you qualify, it directly affects how expensive your mortgage will be. And even a small difference in score can create a noticeable difference in your rate. So what is an interest rate really? An interest rate is the cost of borrowing money. When a lender gives you a mortgage, they're taking on risk. Your credit score is one of the tools they use to measure how much risk they're taking. A higher score means lower perceived risk. A lower score means higher perceived risk. Now, a lower risk usually means you'll end up with a better interest rate, lower monthly payments, and less paid over time. So here's why even a 20-point difference in your credit score makes a difference. Many buyers assume if I'm over 620, I'm good. And technically that may qualify you, but mortgage pricing works in tiers, and credit scores are often grouped in ranges. For example, 580 to 619 would be considered subprime and limit your loan options. 620 to 739 is acceptable for many loans, but may not be the best interest rates. 740 and up would be considered excellent and provide the best interest rates, resulting in a lower monthly payment and less money spent on the life of the loan overall. Moving from one tier to another can slightly improve your rate. That's why sometimes improving your score by just 20 to 40 points can shift your loan terms in a meaningful way. Now, what kind of difference are we really talking about here? What are those numbers? So let's say two buyers are purchasing the same $300,000 home. Buyer A has a 760 credit score. Buyer B has a 640. Even if both are approved, buyer A will likely receive a lower interest rate. That difference might only be 0.5% or 1% even, but over 30 years, that can mean thousands, sometimes tens of thousands of dollars in total interest paid. For example, that $300,000 loan, if we increase the rate from 6% to 6.5%, it adds nearly $100 to the monthly payment and roughly $35,000 in total interest. That's in the overall life of the loan. That's why this question matters. Having looked at those numbers, though, it's good to keep in mind that if interest rates drop in the future, you will always have the option to refinance and lock in a better rate down the road. If you're thinking about moving to the Shreveport-Bossier area, you're probably wondering what life here will be like beyond the interest rates and current market data. Because after all, buying a home isn't just about real estate, it's about creating a life that you and your loved ones can enjoy. Trying to get a feel for a city from a distance can be difficult. I know that firsthand. I remember touring the neighborhoods and asking locals what life here was like before we made our move. So to make things easier for you, I put together a relocation guide to help make your transition smoother and help you to feel at home faster. You can download it using the link in the description. Think of it as your shortcut to getting to know the area. Now let's get back to interest rates and credit scores. So does having a lower score mean that you should wait? Not necessarily, and here's where the strategy matters. If your score is workable and you're financially stable, buying now probably still makes sense. But if improving your score by 30 points can lower your rate significantly and you have time, well, it might be worth considering. This is where having a real-life conversation with a lender really matters. No more guessing and making timing decisions based on old or outdated information. Talking with a lender before counting yourself out or taking on a mortgage with unnecessarily high interest rate moves you from speculation to an informed decision. So what practical steps can I take to improve my credit? Well, I'm so glad you asked. Here's a few quick ones. Number 1, pay down your debt, especially revolving credit card debts. Number 2, fix credit report errors. Check over your credit report and dispute any inaccuracies that could be hurting your score. Number 3, avoid opening new accounts. Any hard inquiries can lower your score even if it's just temporarily. Number 4, time your payments. Always pay on time, especially in the months before applying. Something that can help with that is setting up your payments on auto pay or creating a reminder in your phone to let you know when it's time to pay that bill. And number 5, lower your credit utilization. In other words, keep your balances below 30% of your limits. So for example, you have a credit card with a $1,000 spending limit. Your balance on that card is $300. That means your credit utilization is 30%. So lenders like to see this number pretty low because it suggests that you're not overly relying on credit for everyday life. Now, there are other factors that affect interest rates. Your interest rate is influenced by one, your loan type, whether it's FHA, conventional, VA, or USDA. Also, your down payment amount, your debt to income ratio, your loan terms, whether it's 15 years or 30 years, and market conditions overall. Credit score is powerful, but it's not the only factor, and that's important because credit score alone is not a barrier. It's only one piece of the larger financial picture. Now, when buyers learn their credit score affects their interest rate, it can feel discouraging, but here's the healthier way to look at it. Your credit score is not a judgment, it's just a snapshot, and snapshots change. Strategic preparation ahead of time reduces pressure when the time comes to move. If you know how your credit score affects your interest rate, you can make decisions intentionally, not emotionally. So how does your credit score affect your interest rate? It influences your pricing tier, your monthly payment, and your loan term total cost. And sometimes even small improvements can create meaningful savings, which leads to the next logical question. If your rates change your monthly payment, then shouldn't I just wait for interest rates to drop instead of working on improving my credit? Well, waiting on the market and the government might not be the most proactive choice. Click here to find out why.